Hello traders, welcome back to the Forex Gig where we dive deep into the tool that can help you make smarter trading decisions. And in today's video, we are going to be exploring the Fibonacci Range Trading Strategy. Now, this method combines the Fibonacci retracement level in a range trading environment to help you identify precise entries and exit points in a sideways market. So why not stay tuned with me until the end of this video to learn how to apply this strategy in a step-by-step way. We start by understanding what the Fibonacci range trading strategy is all about, and this combines two essential concepts in a technical analysis. The first concept is the Fibonacci retracement level, and the second concept is the range trading. Now, the Fibonacci retracement is driven from the Fibonacci quick sequence, a mathematical pattern that identifies key percentages such as the 23.6 level, the 36.20 level, the 50% level, 61.8 level, 78.60 level. Now, these levels are used to predict potential support and resistance points on your price chart. So by applying these levels to a range bound market, where price oscillates between both support and resistance zones, traders can identify areas where price reversals are likely to occur. This strategy works best by using the Fibonacci retracement levels to divide the price range into smaller zones, and these zones will help you anticipate where price might pause, reverse, or consolidate within the range. First of all, let's identify a range bound market, and as I can see from my screen, that this market is a range bound market. It is moving in a sideways condition. You can see this is a range bound market. So applying our Fibonacci to this market would give us areas where price is likely to react from or continue in its direction. Applying the Fibonacci to this range bound market, for instance, the 38.2 level, the 61.8 level often act as crucial areas for price reaction, while the 50% level is frequently observed as the midpoint where price may hesitate. So this approach is particularly effective in markets that lack clear trends. As you can see, this market lacks a clear trend but exhibits consistent movement within the defined range. It provides a structured way to analyze price behavior, helping you focus on key levels rather than random fluctuation. So let's see a step-by-step Fibonacci range trading strategy. Let's see how we can apply this to our trading strategy. After we have applied our Fibonacci tool into our range bound market, this market is where price will consistently move between a clear support to a clear resistance zone. You will need to ensure that the range is stable by confirming that the price is repeatedly bouncing off these levels without breaking. As you can see, repeatedly bouncing off these levels. You can see it at this area. Once you have identified the range, you plot your Fibonacci tool in the range. Once you have plotted our Fibonacci tool in the range, you will use your charting tool to draw levels, which will divide the range into smaller zones. And the areas that we are going to draw are our 38.2 level. Change the color a bit. Change the color to a very stable color. This is the first level, 38.2 level, our 50% level, and our 61.3 level. So these are the areas that we are going to pay close attention to in this range. Next, you analyze the price interaction with these Fibonacci key levels. You pay close attention to those levels. You look for confirmation signals such as candlestick pattern or divergence on indicators. So you can actually add your indicator to this setup or to this strategy for stronger confirmation of your trade. So these are the levels we'll be looking at. You plan your trade based on this observation. So if price approaches a key Fibonacci support level, consider entering a buy position provided that the confirmation of the reversal is there. So as you can see, price is in this range. In this area of the range, price decided to come to the support region in this range. When price came to the support region in this range, price broke above it, came back and retested it, and it created a bullish engulfing candle at this area. When price created a bullish engulfing candle, this would have been a good opportunity for you to buy this trade, and you target the next resistance level. This is how we can capitalize on the range bound market. Similarly, if price nears a resistance within the range, you look for selling opportunities. When price nears the resistance within the range, you look for selling opportunities. You see price reacted, broke out, broke in, came back to retest. E stalled. Some people will call this a double top, but we are not making use of all those patterns at this moment. We wait for price to come to our area, give us a bearish engulfing at this area. Even at this area, you can wait for your candlestick formation. This is a shooting star candle with a bearish engulfing candle. This can be a good entry point. This area is a good entry point. This can be a good entry point for your first area. Here is also a good entry point. After this morning star candlestick pattern followed by a bearish engulfing, you can enter at this area. So this is how we can capitalize on this trading strategy, combining our Fibonacci level with our range bound market. So now let's look for another range bound example to further illustrate this strategy. So this is another example of a range bound market. Price is reacting, steadily bouncing between the resistance area and the support area. All you need to do is to plot your Fibonacci levels on this area, and you mark out your key levels that we'll be using for this trade. Our key levels are our 38.2 level, our 50% level, and our 60%, 61.80 level. These are the levels that we are looking at for this example. So since we have plotted this level, all we need to do is to look at how price interacts with this level. You can see when price came to this area, it broke through this support region, it came back to retest this region, and it gave us a hammer candlestick pattern at this area, which will signal a buying opportunity. Remember, this is a range bound market. You need to get in and out as quick as possible, and you can see when we entered after the hammer candlestick pattern, we would have gotten a 1:2 risk to reward ratio. You can also look at this area when price broke to the downside in this range, came to this level that we marked out from our Fibonacci, came here and gave us our shooting star candlestick pattern. You would want to enter after your candlestick pattern of that level. Stop loss below, above the candlestick pattern or above the level. You aim for your 1:2 or 1:3 as the case may be. So you always need to monitor price action closely as price evolves. If price breaks out of the established range, it is essential to reassess your strategy and adapt to the new condition rather than holding on to trades that no longer align with your setup. Alright traders, we have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. If you found this video helpful, do not forget to like, share and subscribe. Turn on your notification bell so that you never miss out on more trading tips and strategies. Thank you for watching, and I will see you in the next video.